Welcome to The Explainer. Today, we're exploring a seriously fascinating corner of the market. We're looking at a tool that actually attempts to bridge the gap between active management and passive indexes. Specifically, we're going to break down the strategy behind David DeBora's Alpha Blue Capital U.S. Small Mid-Cap Dynamic ETF. It trades under the ticker ABCS. And really, our main focus today is figuring out exactly how this fits into an actual portfolio. So, if you've been looking for a way to intelligently diversify your equity exposure beyond, the usual mega-cap tech giants, you are absolutely in the right place. Okay, let's dive right into this and take a quick look at our roadmap. First, we'll cover the small mid-cap opportunity. Second, we'll go inside the ABCS ETF. Third, we'll unpack the VFQM stock strategy. And finally, number 4, ABCS in your portfolio, where we'll see exactly how to put this to work.
All right, Section 1. The small mid-cap opportunity. Looking beyond the mega-caps.
Before we open up the hood on the fund itself, we really need to acknowledge the current market environment. Let's be honest, are you mesmerized by large caps? It's okay, most of us are. It is incredibly easy to have a portfolio that's completely dominated by familiar, famous companies. They make up the bulk of the standard indexes, they dominate the financial news, and frankly, they feel safe. But sticking only to what's famous might mean leaving some serious potential growth on the table. So, let's use that as our Trojan horse to pivot over to small and mid-caps.
Because there's a stark contrast here between comfort and historical reality. On the one hand, you've got that large cap familiarity, but on the other, you have small and mid-cap potential. Historically speaking, hanging out in mid-cap and small-cap territory is actually where investors have often found better long-term returns. It's a less efficient area of the market, right? And that means there's a lot more room for skilled managers to jump in and actually find mispriced opportunities. So what exactly does small to mid-cap mean for the ABC strategy? Well, they define their universe very specifically. They target the less efficient bottom 30% of the U.S. stock market by market weight. To put that into dollar terms, we're looking at companies ranging from about $500 million in size all the way up to the largest stock in the Vanguard Mid-Cap Index, which can sit right around $132 billion. That is their sandbox. Moving right along to Section 2. Inside the ABCS ETF, the active-passive hybrid, I'm super excited to look under the hood here. And this brilliantly illustrates what makes ticker ABCS so unique. It's a structural intersection of 3 very distinct entities. First, you have Alpha Blue, bringing over 30 years of fundamental active stock selection experience through their founder David DeBora. Then, you've got Alpha Architect, providing the quantitative consulting and the robust ETF platform. And rounding it out, you have Vanguard, supplying their best-in-class, passive, low-cost index ETFs. It is a true hybrid structure, blending active conviction with passive efficiency. So how does that actually translate to the portfolio's weighting? Well, ABCS has the flexibility to hold between 50 and 100% in active individual stocks. That usually means about 50 to 150 different holdings. The remaining slice, which can be anywhere from 0 up to 50%, can be allocated to passive Vanguard ETFs, stuff like their small and mid-cap value or growth funds. Just to give you an idea of how this looks in practice, right at launch, the fund was sitting at roughly 65% individual stocks and 35% Vanguard ETFs. It's dynamic, so it shifts.
Now, whenever we bring up active management, the immediate question is always, okay, what's it going to cost me? ABC's comes in with an annual fee of 0.40%. This is a massive point of differentiation. You're getting an actively managed dynamic strategy, but without that typical sky-high price tag you usually see with active mutual funds or hedge funds.
And what's the core goal of paying that 0.4% fee? It's this number right here, 1 to 3%. The objective of ABCS is to generate an annualized alpha, meaning outperformance, of 1 to 3% in excess of the Bloomberg US 2500 index over a full market cycle. They aren't out here trying to shoot the moon. They are aiming for a very consistent, targeted, measurable value add.
Okay, Section 3. The VFQM stock strategy, picking the winners. To understand how they actually aim for that 1 to 3% alpha, we need to look at the specific mechanics used by portfolio manager David DeBora. And it all boils down to an acronym you should definitely anchor in your mind, VFQM. That stands for value, fundamentals, quality, and momentum. The philosophy here is attempting to capture the very best of both value and growth, but strictly at a reasonable price. They're hunting for companies in that bottom 30% that have attractive valuations, incredibly sound fundamentals, high quality, and positive momentum. Now, what's really interesting about this slide is how it visualizes David DeBora's 30-plus years of experience. It's a strict, 4-level hierarchy for bottom-up stock selection. The foundation starts really broad, looking at value and growth. Then it narrows down to analyzing fundamentals and quality. Level 3 filters for momentum and catalysts, like what is actually going to move this stock. And finally, the sharpest point of the spear, defining the target price, risk, and conviction.
Walking through the actual chronological process, you can see it is highly disciplined. First, they screen that massive universe for those VFQM traits we just talked about. Second, they dive deep into the fundamental analysis. Third, and I think this is absolutely crucial, they define a target price and a strict sell discipline before they even buy the stock. Finally, they carefully manage position sizing and risk. The big takeaway here: this is not some rules-based algorithm running on autopilot. It relies heavily on a fundamental analytical edge and real human judgment.
Of course, to truly grasp any strategy, you have to understand its risk profile and know when it might struggle. Because the ABCS strategy is fundamentally value-focused and centered on quality, it's anticipated to outperform when the broader market is actually being driven by value and fundamentals. On the flip side, in highly speculative markets, or when low-quality junk stocks are leading a rally, it is entirely possible this ETF might underperform. It's a fundamental strategy, so naturally it thrives when fundamentals actually matter to the market.
Which brings us to Section 4, ABCs in your portfolio, slotting it in. This is the climax of our explainer.
We know what the fund does, but how does this tool actually get used in your own financial life? Let's talk allocation. We need to be crystal clear about what this fund is. ABCS is not a total single-ticket portfolio solution. You are not putting 100% of your net worth into this. However, what it is a brilliant core holding within your broader equity slice, or a highly targeted satellite diversifier to complement those large-cap funds you already own.
Let's map this onto some real-world investor profiles so you can see where you fit. If you're a purely passive S&P 500 investor, ABCS offers a fantastic way to diversify your wealth beyond those top 10 mega-cap tech stocks, injecting some dynamic management into the smaller end of the market. If you're managing a broad global equity mandate, ABCS provides highly targeted U.S. small and mid-cap exposure. And hey, if you're a private business owner who is heavily concentrated in your own company, this ETF can provide a liquid public equity diversifier that behaves quite differently than your core assets.
So the crucial point is understanding the sizing guidelines. The team behind the funds suggests that, based on its broad diversification, ABCS could comfortably serve as up to 30 to 50% of your total U.S. public equity allocation. It's literally designed to blend seamlessly with the low-cost beta exposure you probably already hold. It's about giving you the best of both passive efficiency and active alpha generation.
And that brings us to our final thought for today. Take a hard look at your current portfolio. Is it heavily skewed toward the exact same massive companies everyone else owns? If so, ask yourself, how could a dynamic, active-passive hybrid in the small and mid-cap space reshape your equity exposure and potentially enhance your long-term returns? It is definitely a question well worth exploring. Thank you so much for joining me on this explainer, and keep learning.